We're live. Hi, sorry. Hi, Yash. Welcome to Venture with Grace.
Hey, Grace, thanks for having me.
Okay, so to start the show, I would love for the audience to kind of know you a little bit more. So you started your career in finance and then in investment banking, and then later on you work at corporate strategy, and then now you are general partner for Titanium Ventures for over 11 years. So why don't
Yeah.
we start with like what were some core lessons that you've learned early on in your career that you kind of took later on to grow
Yeah.
your career?
I'd say like in my career, like if you look at the journey of my career, every stage has sort of parlayed itself into the next stage of my career. And what I mean by that is I started off as an investment banking analyst at Jefferies, doing a lot of sell side tech M&A, mainly in
Mhm,
digital media and kind of software companies.
mhm,
And that's how I basically got to know, Ad Knowledge, which was my next sort of gig where I became effectively chief of staff slash running corporate development. And Ad Knowledge at the time was a venture-backed ad network, grew to about 300 million in net revenues. Doing a lot back in the day when ad networks were sort of a real thing and not sort of struggling with the duopoly of Google and Facebook right now. And so they'd raised venture money from JMI Equity and TCV Technology Crossover Ventures. And so when I was in banking, we actually used to pitch them as a potential customer. And so I got to know them, applied for a job there after my kind of 2-year banking stint. And then, spent about almost 2 years at Ad Knowledge. And, I kind of mentioned this because Ad Knowledge actually led to my current gig at
mhm,
what is now Titanium Ventures, but at the time we used to call it Telstra Ventures. And so, um, I actually, at the time we were looking at potential strategic options for Ad Knowledge. And we actually started looking at the telco space as potential acquirers. And that's where I kind of came across Telstra, which is
mhm,
basically the Verizon of Australia, one of the
mhm,
largest telco and media companies in the Australia region. And at the time, we ended up not selling, the company to Telstra, but I got to know them and a guy named Mark Sherman, who was basically at the time starting the corporate venture arm about a block away from where I was working with in sort of downtown San Francisco. And so, long story short, I got connected to Mark, and Mark and I basically started investing across, a lot of different sectors, but really sort of growing Telstra Ventures, corporate venture capital arm, over 11 years ago. And so I kind of laugh, 11 years is a long time. Either I'm doing something maybe right or something really wrong. You tell me,
mhm.
Grace.
I feel like, why I think that's like such a great like overview on the venture arm as well as like your career. So why don't we talk about like I guess like in the past like 11 years? Obviously, I think that's really admirable for someone to like, be at a place and then like being able to grow within like the company on its own. So like why don't we talk about,
Yeah.
what was it like to building out the practice with your like team member, and then how do you think about like differentiation or like what kind of things that you want to invest in. And then I think briefly we tried about like, being, I guess, like an opportunistic person is better than like, being very niche focused or niche specific. Why don't we talk about how do you guys start, like, I guess, like pick, SaaS, sports, consumer apps, gaming, fintech, and then like how do you think about like what are things that you don't want to invest in versus what are things that you want to invest in?
Yeah, no, a lot of great questions. I think three or four. So I think I've got them. So I'll kind of tackle them one at a time. But the
Mhm,
first is really, how I got started with my partner, Mark Sherman, to really kind of, get Telstra Ventures up and running in sort of North America. And really, when I kind of left Ad Knowledge, I wanted to, join a business where I could really make an impact, right? And so,
mhm,
a lot of folks, when they join as a senior associate at the time, is when I joined at a venture capital fund. You can kind of join, many of the larger funds, very great funds like Andreessen Horowitz, Excel,
mhm,
Sequoia. Everyone knows those folks. You can join more of the boutique funds out there, more of the sector specialist funds.
mhm,
Venture as an asset class has exploded in the last, kind of decade or so plus. And you have your sort of pick of the litter, particularly as many of these funds raise more. At the time, we're raising a lot of capital and really needed not just junior, but kind of mid-level and senior folks to help source deals, vet investments, add value to portfolio companies, either through boards and in other ways. And so when I kind of thought about the next stage of my career, joining Telstra Ventures was not an obvious choice. It was sort of a relatively unknown kind of entity at the time. And one of the most important things was I would be able to make an impact and have a lot of autonomy, right? And so
mhm,
at the time, Mark gave me a lot of autonomy to source and lead deals. And
Mhm.
we initially did a lot of interesting deals. Companies like Box and the cloud storage side, or
Mhm.
DocuSign and e-signature space.
Mhm.
And over time, I started to, we were doing a lot of enterprise software investing, and that was good.
Mhm.
But started to push the boundaries around consumer tech investing. And so one of the first investments we made was in a company called Snapchat,
Mhm.
and that was really exciting. But I don't like to be limited in terms of the sectors I go after, the type of founders I want to back, and
Mhm.
sometimes you sort of get pigeonholed at some of these larger funds or more sector specialist funds. But I personally believe some of the best returns come from more opportunistic kind of sourcing of deal flow, and obviously getting pretty nitty gritty in the detail and becoming domain experts. But when we sort of look at a lot of sectors, there's a lot of sectors and sort of themes that come and go from cloud to mobile to blockchain to now
Mhm.
AI. There's a lot of different sectors, and if you were to sort of pigeonhole yourself as a sector specialist in one of those four, you might miss out on some really
Mhm.
great venture returns. And so that's kind of been my philosophy. And going back to why I joined Telstra Ventures,
Mhm.
we were really excited about growing the venture arm and really, frankly, just making great bets and backing,
Mhm.
what I call force of nature founders. And so being
Mhm.
able to do that with more autonomy from my
Mhm.
perspective and allowing me to grow into being a general partner, which isn't
Mhm.
always possible at some of these larger funds, was something I was really excited about. And so, because of that autonomy, I was able to make some really interesting bets, get a lot, of companies that, and eventually ended up going public, getting sold. I had two kind of that went liquid last year, which was really nice from a liquidity perspective for our fund. But that's been really the main reason why I joined Telstra Ventures. And so I call them Telstra Ventures, but last year we actually rebranded to Titanium Ventures. And so
Mhm.
we're actually now Titanium Ventures. So I'll kind of refer to us as Titanium Ventures moving forward. So hopefully that makes sense on why I joined Titanium Ventures. But happy to kind of tackle the other kind of three questions you mentioned as well.
Yeah, totally. I wonder, so when you were thinking about like, I guess like building a brand in the US, I guess like when you so since like I mean I personally have also worked at like, overseas company, but like starting up their like UX practice. And I wonder, how do you think about like building a brand within like a new ecosystem, as well as like I feel like in at the beginning when you are trying to get into like these like really hot deals like a Snapchat, like a BigCommerce, those are like, or box, or like, all these deals are like very chased by a lot of investors. How do you kind of differentiate yourself and then like, um present the value proposition to the entrepreneurs? And I guess like how do you kind of like source in general at the very beginning
Yeah.
to win these deals?
Yeah, that's a great question, Grace. And that kind of value add and differentiation, especially from an entrepreneur perspective, has kind of evolved over the years. So when we first started out, this was January 2014 when I first joined
Mhm.
Titanium Ventures. We were really trying to build a brand and some credibility as not just a corporate venture capital investor, but as an investor more generally in Silicon
Mhm.
Valley. And so frankly, we did a lot of later stage investing where we weren't necessarily leading or co-leading deals, whether it was DocuSign or Box, but we were tagging along and trying to add value in ways that was differentiated as a CVC at the time. And so what that
Mhm.
practically meant is we were able to help drive synergy revenues, is what we call them, by moving the needle from a revenue perspective by customer introductions or
Mhm.
resell or channel partnerships through Telstra, which was
Mhm.
one of our, is our big LP. And that was very helpful for a lot of companies. Box, in particular, and Aaron Levy was a big fan of us at the time for helping grow the APAC sort of region for that business.
Mhm.
We try to do a lot of work also with DocuSign in that regard. So practically, I think a lot of entrepreneurs and companies appreciated, hey, they're not just coming with a $7-10 million check. They're actually moving the needle from a revenue perspective through their relationships on the customer side with Telstra and other partners in Asia Pac. So that was one thing that was really helpful in the early days. Over the years, we started to build a lot of credibility with entrepreneurs that would sort of spread through word of mouth, right? So some of the founders and CEOs would sort of, get back channels on us saying, hey, Yash and Mark, they're great guys to work with. They're very founder first, and they'll, hustle very hard for you, whether it be recruiting a new CRO or it's getting an intro to your next investor at a Series C or D.
Mhm.
Whatever it takes. I think we were very scrappy in the early days, and we continue to be. And so that sort of reputation started to build pretty quickly. And fast forward to today, we have made over 100 investments.
Mhm.
Both the companies active in our portfolio and those that have sold or exited, and over 60, 70 are sort of active right now. And that sort of reputation spreads with a bit of network effects. And I think for us, we spend a lot of time kind of measuring our NPS score with our entrepreneurs. It's probably the
Mhm.
number one KPI North Star metric we look at.
Mhm.
In addition to DPI and TVPI and all the usual IRR metrics that our limited partner
Mhm.
investors care about. But that's I think been very critical moving forward. The final piece I'll mention from a differentiation perspective is we have a very strong data science effort within our firm, and we've got some great folks that help us not only get more quantitative around our deal sourcing, but also how we can add value post investment through a lot of our very proprietary data insights, whether that's benchmarking companies in terms of what looks right from a best of breed sort of top quartile SaaS company in the GovTech space, as an example. And so that's been something we're very proud of on the data science kind of AI investing side. And so I'd say across those three, I call it hustle, revenue kind of bearing relationships is what we call it in terms of moving the needle with customer intros and resell channel partnerships, and data science. Those three things have been core to us as we've evolved over the years. The final piece I'll mention is we absolutely believe that investing in tech is really investing in great people. It's all about great personal relationships and in maintaining those moving forward. And so company building is not for the faint of heart, and we absolutely take very serious our kind of commitment to our entrepreneurs. And so it's very much people driven, and so that's kind of a soft, fuzzy, hard to sort of quantify value add. But when we talk about investing in companies, it's really a partnership, almost a marriage that we kind of consider very carefully.
Totally. Okay, so I think another question I have for this is like, since you guys invest in so many different companies in different sectors, how do you think about like the check size and portfolio construction
Yeah.
when it comes to like, investing in various different sectors, because their valuation could vary, and then also the different stages, the check size could vary as well. How do you think about portfolio construction in that sense?
Yeah, in the early days, as I mentioned, we were trying to build credibility in our brand. So I would say we did a
Mhm.
lot of logo picking, right? Investing in category leaders, which naturally was sort of Series C, D, and E type of
Mhm.
investor, where it was certainly past post product market fit. They were inflecting very fast, but they might have like 5, 10, 20 million in revenues, and it became very clear that hey, at this investment we could maybe drive a 5x plus return. It may not be
Mhm.
20x, but it was going to be a very solid return for our investors, our LP investors. So that was the early days. If you fast forward to today, we really focus, I'd sort of say, on Series A and B and what we call post-product market fit inflecting companies. So much
Mhm.
earlier, and I'd sort of say 1 to 10 million in revenues is our typical profile.
Mhm.
That's very different from the early days, and part of that has been sort of in response to the kind of changing environment around venture and where we see the best returns. And a lot of that is driven by macroeconomic conditions. The IPO markets have been sort of a bit cold, and the credit and sort of interest rates have been a bit higher for the past few years since 2021. And so there's just been less liquidity in terms of big M&A deals or even IPOs in the past few years, which makes it easier to kind of get comfortable with a better return at an earlier valuation and selling a company for maybe 400, 500 mil, so sub 500 mil, as opposed to expecting a 1, 2, 3, 4, $5 billion outcome. So from my perspective, moving earlier, buying 10% equity versus having a couple percentage points, and really doubling down on some of the winners, became more comfortable from our perspective, and that's kind of been our strategy more recently. And so I've been very proud of some of the companies that I've backed in the past. But I'd say moving forward, we're sort of taking bigger bets, buying more equity, and taking more board seats. I think in the past we probably were more just board observers, just because our equity didn't really justify having a board seat. But we find that rolling up our sleeves, adding more value, and really, frankly, doing pro rata rights and super pro rata rights with our top quartile companies is a really strong kind of way to drive more returns. And
Totally.
that I think will continue to be the case for us moving forward. So really A's and B's.
I wonder when I want to go back to at the beginning, back in 2014, 2015-ish. Like, so when you were saying, like, obviously you guys add a lot of value through, recruiting core company members, or like introduce to investors, or like leveraging data to help portfolio company to benchmark some sort of like success, or like benchmark some important like KPIs. And I wonder, how do you think about uh like, I guess, like getting into the big logos, because I feel like that's also very, very hard at the beginning, unless obviously, I think having cash is one thing. The other thing is like, you have to tell the founder about the value add. You kind of have to sell yourself at the very very beginning. What was that journey kind of like? I guess, like, how do you think about the 0 to 1 as building the firm back then?
Yeah, this is an interesting kind of point you bring up, because I think it's sort of, my answer is a bit counterintuitive. I think in the early days when we were
Mhm,
trying to get into Snapchat and some of these
mhm,
bigger logos and names,
mhm,
it was a lot of cold emailing from my perspective. We
mhm,
definitely had a solid network, early network of other investors that were on the cap tables of these companies. But as an
mhm,
example, I kind of cold emailed Evan Spiegel and Imran Khan, who was the CFO,
mhm,
back in the day for Snapchat, just explaining the value add of Telstra as a potential telco partner, leading with sort of the partnership angle versus necessarily wanting to invest in the company, and leading with that angle. And so when I look back at the early days, Big Commerce was another cold email.
mhm,
Skill, which ended up one of our mobile gaming companies that I invested in, ended up going public through a SPAC at a $3.5 billion valuation. That was a cold email. Some of my best returns have been kind of cold emails, and it's kind of interesting. I kind of joke that the type of entrepreneurs that respond to cold emails are sort of indicative of the type of entrepreneurs that you're going to partner with. They generally tend to be hustlers. They're very creative. They're open to new partnerships and opportunities. And I think that's personally been a really interesting indicator or proxy for
mhm,
whether I will, whether this partnership will work as a venture investment. Not saying that it's always the case, but there's definitely more recently been a lot of great in the companies we invested in through our network, especially at the pre-seed, seed, kind of earlier stages where we know a lot of these angels, et cetera. That has happened more organically over time. But from the early days, we just had to hustle, right? It was just pure like we've got to outwork these guys. And a lot of that is, you almost feel like an SDR or an AE kind of cold
mhm,
emailing, prospects. And
mhm,
I feel like, the venture game, especially in the early days when you're trying to build a brand, is not too dissimilar. We're almost like AEs, but we're selling a product in terms of capital and other
mhm,
value add with really long sales cycles. So the early days was really a lot of cold emailing and hustling and
mhm.
really crafting the right narrative to appeal to these folks. So that's kind of how we did it in the early days. But over time, it's now shifted to entrepreneur referrals from within our network through other kind of earlier investors that help us vet some of these particularly early stage companies.
Totally. I wonder, so like when you were I guess cold emailing the entrepreneurs to eventually closing the deals, I think it's like two different things. I think getting the meeting, of course, that's like a really big milestone. But I guess, like, first of all, can you share a little bit more about like what was on your market roadmap? Like, for example, like a Snapchat, obviously it was like a very popular deal. But I
Yeah.
guess, like, from the financial level, how do you kind of like study the return side of things to, like, tell the LPs slash like the corporate that like this is like a valuable bet? And like, how do you when you're like actually negotiating with a founder, or like showing, like, meeting the founder, what were your preparation kind of look like? Just like, because I feel like that's goes into how you close them. Because I think when you meet them, that's just like the first step. Like, what was the later on follow up process kind of look like for you?
Yeah, so when we're evaluating new investments, like a lot of the work, I would say I upfront, like I do before I even reach out to the entrepreneur. So
Mhm,
I think there's two or three things that we really focus on. One is the team is phenomenal, right? They've got
mhm,
founder market fit.
mhm,
We think that they have sort of a unique insight or sort of edge in terms of the industry they're attacking and building in.
mhm,
So that comes through a lot of background checks and referrals that you either do upfront or concurrently as you're talking to the company. Number two is product market fit and the product being the best in class, whether that's G2 crowd reviews for enterprise software companies, whether that's App Annie or similar web data. And this is where our data science team comes in to help us evaluate and vet that these companies and products are actually top tier class. And so that's very important. Number three, it's sort of say like, timing is everything in venture, right? So it's not just about team and a great product, but sometimes there has to be sort of some change event that you can get comfortable with around sort of a tailwind that will lift not just this company, but all the boats,
mhm,
with this rising tide. And so I kind of talk about those four kind of change events in the past decade plus between cloud, mobile, blockchain, and kind of AI now. And so if there's sort of, and there's others, right? Climate tech is very popular. We're sort of seeing, frankly, out of the necessity, a lot of more investment and kind of entrepreneurs focused on climate. But there's a lot of different sectors, themes, and sort of change events. But you kind of have to have one in addition to the other two kind of, sort of pieces of criteria I mentioned. And then number three, this comes without saying, but this is like key KPIs, financial metrics. Like I get very in the weeds around, how does day 30 retention look like for a real money gaming app? How do you benchmark that? How does day 160, or sorry, day 180, how does retention look like? How does for enterprise software companies, net revenue retention is really key, low churn, all that, sort of usual stuff, which is, I think, frankly, table stakes, but we
mhm,
definitely try to vet that out pretty quickly early on. So that's how I look at it. And in we have our internal memos like most venture funds, and we kind of write up all our findings there around our diligence around all these things. And then, I'd sort of say when we're meeting with these entrepreneurs, the value and how we prepare is what can I do for you, right? And so if there's sort of something I've read about that the company is looking to maybe execute in a new region and they need to
mhm,
hire a GM of Australia, I'll sort of go through my networks and say, hey, maybe this could be an interesting candidate. Is there some sort of biz dev connection or relationship with one of my other portfolio companies that could be really interesting for these folks? And in many cases, especially as their portfolio has gotten bigger, the kind of cross pollination of different commercial partnerships and relate and sort of customer relationships between different portfolio companies has actually been really interesting. And so that network effect has gotten bigger over time as our portfolio has gotten bigger. But it's really ultimately trying to understand how we or I can specifically add value, through some new hire, through a customer intro, through some sort of unique insight that maybe I can kind of provide, and so that's really how I think about it when we prepare.
mm. I wonder, so like I really like what you said about like, like for example, you would like do all the research as well as like timing as a lot of things, and then timing is everything. Also, you would go to like, all the other data scientists and maybe G2 review or like App Annie and stuff like that.
Yeah.
And I wonder, what would you say are like the I guess like after you meet with the founder, what was the conversation kind of look like? Is that like, hey, we want to partner with you because we could provide XYZ, and then you need XYZ to move to the next milestone? Or like, was it more of like a vibe check? Like, they just think you're great as like a human being or easy to chat to? What was, I guess, like how does a closing or like I guess like
Closing video.
demonstrating,
Yeah.
yeah,
Yeah,
kind
and
of.
frankly, it's kind of both, right? It's
Mhm,
definitely a vibe check and relationship check. As I mentioned
mhm,
earlier, like personal relationships are key, and we look at these investments as almost marriages,
mhm,
and so you're going to be in this relationship for the rest of your life, or however long the company continues until they get sold or go public,
mhm,
right? So
mhm,
that's a huge part of it. Don't underplay that. And one of the things that I like to do is, before we close an investment, but ideally sooner rather than later, is we have several dinners, long dinners, to kind of chat, get to know these founders personally, understand what makes them tick, help them understand what makes me tick, and what I get excited about. And so that's very much, I'd sort of say, part of the vibe check, which I think is critical. Probably more important. But to I think the first point you mentioned, which is what specific milestones and value add can we bring? Can there be a customer intro? And we try to bear, a lot of, fruit around sort of our Rolodex, and actually make, actionable tactical intros that move the needle from a revenue and customer perspective. But sometimes it doesn't always move the needle. It's just connecting with another thought leader in our portfolio, as an example, and sort of helping these founders, sort of effectively, strategize with not just us, but others, in our portfolio. So I keep going back to cross-pollination, because as our portfolio has gotten bigger, we host these kind of founder dinners, almost like, every year we host founder dinners with all our portfolio company CEOs, and that has been insanely popular. And it doesn't matter what sector you're in, whether you're a digital lottery app, or you're a government tech software provider. These founders love bouncing ideas off each other, understanding how to scale businesses. And so I think sometimes those are equally as valuable as maybe an actionable customer intro.
For sure. I wonder, so how do you think about like what if like, I think as I feel like there's a lot of emerging manager who are listening, and then what if like they got asked like, for example, let's say like a lot of these like bigger funds, they have a big platform team. And then
Sure.
how do you kind of like compete with, let's say, the big platform team that can, do the PR for you, do the marketing, do the recruiting, and like there's like five, it's basically running like a company that like they do everything for you. So how do you think
Yeah.
about like, the competing with like other people with other resources and all that kind of stuff?
Yeah, look, I think there's nothing wrong with providing a platform to help with PR, marketing, and HR. I think one of the signals that I look for in a founder, and I've seen this with founders, is some of the best founders and executors
Mm,
don't want to rely on sort of a watered down version of a platform team that would outsource their HR and marketing and whatever it may be. It's helpful in the early days to kind of, get the right, bearing straight around what you should be looking for in a PR firm, et cetera. But to completely outsource to a venture platform, key functions, is probably
mm,
not going to be sustainable for the entrepreneur and the company moving forward. And so, some of the feedback, and we talk to our founders and ask them what really adds value. But some of the
mm,
feedback we get is, I think one of the biggest pieces of value add is around recruiting, right? Because this is all
mhm,
about people and just recruiting the best talent available, whether it's AI or SVPs of engineers, AI researchers, a chief people officer. These are actually very topical kind of key candidates I'm helping our companies, recruit
mhm,
from right now. And so connecting them to the right exec recruiters, connecting them with people in our network to help recruit or place some of the people from other companies that are now looking to do the next thing. That's probably one of the biggest pieces of value add moving forward. The other
mhm,
is helping them do warm intros for the next round of fundraising. And that's really important, because it helps, the next fundraising round happen, with sort of, a bit more vetting from the new investor's perspective, and they get more comfort there. And everything else is a nice to have, but when we kind of survey many of our founders, they kind of respond back that it's not really mission critical from our perspective, and if it was, we would be hiring and doing this internally. So, from my perspective, I think it's a nice to have, but it's not a core differentiator for a lot of the bigger firms. It really comes down to people, right? Even if you consider yourself a platform firm, like a Hollywood agency, or you're a boutique kind of venture firm, ultimately the founders want to know who the GP that will be sitting on their board is, and whether they get along, whether they can strategize and whiteboard, and really be in it for the long term in some difficult times, especially, as well as good times. So for us, I'm not sure venture as an asset class can kind of scale, in the same ways that we kind of defined venture kind of in previous years. With sort of larger funds and 300, 400, 500 people working at them. I wouldn't even call that sort of venture anymore. It's just a different game, and nothing wrong with it, but it's just not probably what I sort of consider company building. It can be helpful, but I think for us, we're trying to get in the trenches pretty early on and really add value, roll up our sleeves, and you can kind of outsource a lot of that to these platform funds. But I would sort of say the best entrepreneurs want to do that themselves, and they want
Mhm.
guidance around how to do that themselves versus you doing it for them.
For sure. Give me like literally 2 seconds because I think the grass person is coming. So
Yeah, no worries.
sorry, I just shut down the window just in case if we
Yeah,
hear major noise. Okay, I have a question on like so since like on your website there's like the I guess like, there's like a revenue growth accelerator or like acceleration platform. Would you want to elaborate more about it? Like how does it work? How do you guys like leverage the data or like to accelerate the revenue?
Yeah, that was kind of what I referred to earlier as what we call revenue
Mhm,
bearing relationships. And so
mhm,
that's effectively, and it doesn't always apply to every company to be open, right? But
mhm,
for companies that are looking to expand, many times, as an example, in the cybersecurity space, we have a lot of cyber companies. They want Telstra as a customer. It's a great logo to have. It's like getting Verizon or AT&T to kind
mhm,
of validate your tool. And so we can make that connection, pretty easily through our relationships there. And
mhm,
so Telstra can be a customer. And so that would be moving the needle for a company. And maybe it could be half a million,
mhm,
1 million, $2 million kind of ACV contract. The other way we do that is through resale channel partnerships. And that's not just through Telstra, but through other partners in India, Japan, and other parts
mhm,
of Asia Pac that really we can kind of help co-sell many of our solutions and tools, not just one portfolio company,
mhm,
and provide a more holistic solution for many of the top enterprises and organizations in Asia Pac. So it's really slanted more towards Asia Pac and Australia, just given the
mhm,
heritage of Telstra. But increasingly, we're trying to add value with customer intros in New York and Silicon Valley, and we've built that out, pretty robustly over the years. So that's kind of what we call our revenue bearing relationships or synergy relationships. That's getting CIOs together to kind of have dinners and meet with two or three of our companies, as an example. That's going to a Golden State Warriors game or a baseball game and getting them all in a box suite and really sharing ideas, and hopefully that leads to maybe one or two key leads that become big customers. That's sharing
mhm.
kind of thought leadership, et cetera. So that's on the revenue bearing relationship side. And then I'd say on the data science side, that's really about kind of sourcing new deals primarily, as well as kind of helping add value post investment in terms of benchmarking.
For sure. I wonder when it comes to like working with Telstra, like how do you guys kind of like having the synergy between the fund and the mother company?
Yeah, look, they're a very important partner to us. They've always
Mhm,
been, not just when we were part of Telstra, but when we spun out of Telstra in 2018, we became effectively Titanium Ventures. So they're an LP investor,
mhm,
really, and we have
mhm,
a similar relationship to them that we have with many of our other limited partner investors, and I
mhm,
think that's been very fruitful. And from their perspective, they want to see great returns. They want to see great money multiples, great IRRs, just like any other LP investor. But
mhm,
they also do benefit from that special relationship we've always had around, us being a former CVC that spun out of Telstra
mhm,
back in the day in 2018. And so we'll always have that kind of partnership, that relationship moving forward. But for us, we treat them like any of our other LPs, and frankly, they want to be treated like any LP and care about the important things that LPs
mhm.
care about, which is just making money. And so like, I think that's I think like the truth of it, and I think all
Mhm,
LPs care about liquidity, right? As an example, and so
mhm,
like last year, I was very fortunate to have two of my companies go liquid. One of them was OpenGov in the GovTech space, which sold for $1.8 billion to Cox Enterprises. Another one
mhm,
was a company called Jackpocket in the digital lottery space, which sold to DraftKings for $750 million. So when
mhm,
we talk to our LPs, Telstra being one of them, they get excited about those type of outcomes, and not that they don't care about sort of the other things, but really as a large corporate doing 20 billion plus in revenues, synergy revenues don't move the needle from their perspective. Where they benefit is insights around what's happening in the future of technology, AI, cloud, mobile. cyber, climate change, vertical SaaS. So they care about insights that we provide, like we do to all our kind of portfolio, our LP investors each quarter. So hopefully that makes sense.
Totally. Maybe we could talk about the, I guess, like the spin off story. So like for example, I feel like
Yeah.
there's a lot of like CVCs that eventually becoming its own entity. And how do you think about like, I guess like positioning yourself in the market for other LPs, because like the other LPs, like do you go for a similar category, or like do you go for like a completely separate category? Since I feel like there may be a lot of synergies for other telecom companies to like invest as well into the same thing. But on the other hand, like since like they were your original, like the um I guess like the original I don't know if it's called mothership, but like basically
Yeah.
original like mothership for like as a major supporter, maybe you just go for other sector instead of like shit like you just fishing the same sector for LPs. How do you think about like building out like a separate fund than like a corporate entity?
Yeah, no, absolutely. So look, at a high level, like when we spun out, we basically there were not a lot of precedents out there, right? People, I think the ones that we looked up to are like SAP and
Mhm,
Sapphire Ventures and that sort of spin out that happened over the
mhm,
years. And Google Ventures, which became GV, Intel
mhm,
Capital, which recently kind of has kind of disbanded and sort of has been being sold. So there haven't been that many that have been very successful and sustainable. But when ultimately when you spin out, you got to have a good track record, financial track
mhm,
record. And we were fortunate to have really good outcomes with sort of DocuSign, Box, and some of our
mhm,
earlier portfolio companies that showed that we can multiply capital. We can prove this. We've proven this out, and it's sustainable. And so when we kind of spun out and looked to diversify our LP base beyond Telstra, who was very supportive of us, we kind of went to these other LPs, both strategics as well as endowment funds or superannuation funds as they call them in Australia, which are effectively pension funds for many Australians. And they were looking at many of these kind of same metrics that Telstra is looking at, or any LP, whether you're financial or strategic, are looking at. And so ultimately, that comes down to like money multiples, IRR, and liquidity, like DPI is what they look for, which has been fortunate for us. It's been very good, for our fund two, which was the one that we spun out of. So from our perspective, it's no different than sort of selling into a strategic LP like Telstra. Sometimes there's sort of opportunities to replicate that Telstra relationship with a new strategic, right? And so we're always looking for those opportunities where they want to get more involved with our portfolio companies, and they want to co-host events with our portfolio company CEOs, and they want to actually maybe benefit in the same way that Telstra has benefited in the past. But it's by no means a requirement from our perspective or even their perspective to have that. And so that's very opportunistic in nature.
Mm. I wonder, so like I think like one other things I thought about is like like when we at the beginning we talk about like being having a very diverse portfolio or like being opportunistic. How do
Yeah.
you think about like what in terms of like timing, what are things that you're looking at now? Because I feel like right now everyone's talking about AI, but like the AI valuation is like also very high, and it's
Yeah.
also super hard to like actually pick the winners because like a lot of the, I guess, vertical AI things are very competitive. Let's call it like the legal space or like
Yeah.
just like every other space. Like there's like a lot of like companies that are rapidly coming out of a specific sector. How do you
Yeah.
filter out things that like you're not interested in, or like what are something that you're looking at now that you feel like it's actually not very obvious right now, but it's or like it's undervalued right now, but it will like actually go up later.
Yeah, I'd sort of say like AI, I kind of look at as just, and I'd say the same with cloud, mobile, and
Mhm,
blockchain, previous
mhm,
kind of hype cycles there. These are just inputs into effectively technologies that drive different tech stacks that disrupt different industries. And so when I look at, areas to invest in, I try to prefer to focus on very antiquated industries that don't
mhm,
historically have a lot of innovation. And so
Mhm.
that historically has been areas like construction. I just led an investment in a vertical AI kind of construction compliance tool
Mhm.
called Document Crunch, which is doing really well. That's areas of SMB and fintech, a company called Flex, which we just announced a Series A investment in. I'm on the board of as well, which is sort of a Brex or Ramp competitor. That's areas, like the lottery space or real money gaming, or sports betting, which have become legalized in the past few
Mhm.
years and are now are massive TAMs or total addressable markets, but haven't seen a lot of innovation, from an end consumer perspective. And so
Mhm.
when I look at areas to invest in, it's more with a way for solving, a customer pain point that will drive a lot of value. And AI could be an accelerant in that, right? And so
Mhm.
many times the companies I'm looking to invest in, they're not leading with AI, they're not leading with blockchain, but they're
Mhm.
actually built on sort of, blockchain or AI to kind of
Mhm.
drive a ton of value for these customers.
Mhm.
And I'd sort of say the same thing with cloud and mobile in the past. Like when we kind of looked at, a whole bunch of mobile apps in back in the day,
Mhm.
we wouldn't say, hey, this app is, built on AWS and it's built with PHP and it's built with, sort of on the Android ecosystem. We would just say it's an app for ordering food, right? And so it's just like solving a real customer pain point that has been accelerated by some of these change events on the technology infrastructure side
Mhm.
as well. So when I kind of look at investing from our perspective, we've looked at a lot of different areas. I personally like a lot of vertical SaaS or vertical AI opportunities. I mentioned construction. We have a company called BuildOps, which is doing really well, sort of a service titan competitor.
Mhm.
We have, I look at the maritime industry. I'm looking at a company out there. Unsexy industries that are ripe for disruption. And then,
Mhm.
I'd sort of say we've looked at a lot of the infrastructure and the foundational model layer for AI and find it
Mhm.
very intriguing from an end kind of customer and user perspective. We actually use a lot of these foundational model tools and AI tools out there for our own internal data science efforts as well as sourcing efforts. But we find it very hard to invest thoughtfully as a venture investor and generate kind of 10x plus returns with the
Mhm.
amount of capital required, the amount of compute required, the amount of recruiting and how expensive some of these top AI researchers can be to kind of build out, some of these tools. Not to mention they're super saturated from a
Mhm.
competitive landscape perspective. And so we've sort of stayed away from all the foundational model kind of infrastructure companies. But, we've sort of invested in other picks and shovels, around data pipelines,
Mhm.
things that, will benefit from AI tailwinds in
Mhm.
addition to the application layer. And so that's been pretty interesting, from our perspective.
Mm. I really like what you said about like, instead of like thinking about investing in AI, but you think about like the traditional sector and then like AI or like blockchain or any technology, just kind of like powering it to like
Yeah.
make it better. And why don't we talk about like maybe since you mentioned about Flex, maybe we use it as an example on like how do you kind of source it to like I guess like study the competitive landscape. Let's like you mentioned, like there's like Brax, Mercury, or whatever, like or Brax or Ramp, like whatever, like in that sector, like how do you think about the differentiation for this company? And then how do you think about like the diligencing them to like winning the deal to exiting? And like another thing, like I really want to cover is like exiting. So like a lot of people just think, oh, it's really taboo to talk about like thinking about like how you're gonna exit. But I actually feel like it's very important to think about obviously think about the best case scenario, but also as an investor, you have to actually have the prediction on like what if things goes wrong and like how do you actually think about exiting or like evaluation on a company when you're like decided to invest or not.
Yeah, totally. Like, I guess the last two companies I invested in are Document Crunch and Flex. So I can talk about those both. But like,
Mhm.
when we maybe addressing, kind of the last point first, because I think it's really important, is we're always investing in founders and companies that are shooting for the stars. But if
Mhm.
they land on the moon, we want it to be a really good outcome as well. And so we always think
Mhm.
about base case scenarios around trade
Mhm.
sales that would happen at maybe 500 mil or less, which might be like a 3x plus return and would be solid for us, but not what we aimed for originally, which is we're always aiming for companies that can
Mhm.
be publicly listed, enduring
Mhm.
companies generating 500 million revenues a year, multi-billion dollars in valuations. Obviously, not every company will achieve that, but when we look at underwriting these investments, we look at a lot of the universe of potential buyers. So, as an example, when we looked at sort of Document Crunch, they're a construction AI kind of platform. The natural buyers in this universe are sort of Procore Technologies, which is a $10 billion plus
Mhm.
construction company, or Autodesk, which is sort of a semi-competitor in the space. So we do diligence checks with those folks to make sure that they are interested in the company and the space, and this can be interesting. That's not sort of the aim, but it's more about understanding the base case. In the case
Mhm.
of Flex, in the fintech space, right? There's a whole bunch
Mhm.
of folks that have raised Brex and Ramp at multi-billion-dollar valuations. You've got JP Morgan Chase, American Express on the more larger incumbent side that are servicing SMBs, consumers, and enterprises from a fintech perspective. And so we spend time with all those folks to understand, hey, in a base case scenario, how interested could these folks be in partnering and eventually leading to some sort of trade sale? So for us, it's about understanding the buyer universe, doing kind of product diligence and customer diligence and partner diligence with these potential partners that eventually become acquirers, and understanding that those are all positive. That's a base case scenario. And when you frame it like that with entrepreneurs, they really appreciate that, because ultimately companies are not sold, they're bought. And that starts with a partnership, and a
Mhm.
partnership leads to an M&A outcome, which could be a
Mhm.
really big one, like in the case of Google and Wiz, or it could be maybe just more solid, 3x plus return at $400 million. And so when you frame it like that for entrepreneurs, and have that conversation with them, they're really excited about that. But ultimately, usually they're pretty aligned with us. They want to generate a massive company, and they want to have a big impact with what they do in their professional lives, as do we as investors. So we always try to vet that out. Companies that are not looking to create sustainable, large, kind of businesses that have a real impact or disrupting an industry, they're probably not going to be companies we invest in the first place. So
Mhm.
I think level setting early on is really important. And the way I frame it is kind of how I mentioned it. Kind of understanding who the partners are, which could be a base case scenario, and then understanding what valuations could be in sort of an IPO
Mhm.
type of context. What adjacent markets do you need to conquer to
Mhm.
basically get to 400, 500 million in revenues?
Mhm.
So hopefully that makes sense. And then maybe to address your first point, I think you asked how we sort of sourced and led diligence for Flex and Document
Mhm.
Crunch, but really, a lot of it for both those came from internal kind of referrals from other entrepreneurs for both those
Mhm.
companies, and sort of that was very helpful. These were cases where they were not actually cold emails, right? Like I talked about
Mhm.
earlier in the podcast, I was doing a
Mhm.
lot of cold emails, and that was good. But I think over time we've actually built up a really nice network where we can
Mhm.
actually get referrals that are pretty vetted from our
Mhm.
perspective, and so that helps with the diligence and helps us get conviction quicker when they come from entrepreneur referrals from within our portfolio, or other respected investor kind of referrals out there. And so for both cases, we did a lot of customer diligence, probably 5 to 10 calls on customers and partners, asking them to rank the product, asking them to explain us why they're differentiated from the other 5 competitors out there, and rank them from a scale of 1 to 10, and ask if they partner with them, would they be a customer, all that usual fun stuff. We do a lot of technical diligence, get under the cover of the risks and opportunities from their tech stack, how they can benefit from some of these other inputs I talked about earlier, whether it's blockchain or AI, that could accelerate, their product velocity, their product roadmap. I'd sort of say on that last point, the third piece I spent a lot of time on is the product roadmap. How robust is that, and who's leading product? Who's kind of the visionary there? Because that can be ultimately the differentiator longer term for many of these companies that in the early days they may be getting good customer traction, but the product may not be yet having that big of a moat or differentiator. But there could be something really significant over time. And then the final piece I'll mention is what sort of distribution edges do they have, both on the
Mhm.
consumer or the enterprise side, right? What partnerships do they have? In both the cases of Flex and Document Crunch, they had some really strong distribution edges that got us really excited.
For sure. Speaking of like traditional company that like kind of uh investing in like the traditional sectors, I guess, do you have like a roadmap, or like do you, I think as you mentioned, like Flex or Document Crunch are like both from existing portfolio founders or like just founders that and how do you think about like, are you one of the investors who would do like a whole map on, like, let's say in the construction space we have, XYZ
Yeah,
subsector, and then this is like in the X sector, and then we talk to, I don't know, every company from that sector. And then we
yeah,
get like a result, or like we get like a vibe check on like who we should go after. Or like, do
yeah.
you feel like the trust from like the existing entrepreneur or like existing network person is more important than the, you do like a whole sector rundown on finding out the
Yeah.
winner?
Yeah, it's a great question. So I think we're both, right? I'd say 50% of the time I'm thematic, and typically
Mhm.
we have a major and a minor. I'd say right now my major is sort of vertical AI apps, and my minor is consumer tech. Previously, it was flipped. A lot of it was consumer
Mhm.
tech, gaming infrastructure, and maybe more enterprise, kind of vertical and horizontal application software, which I think evolves over time as new kind of trends emerge. But typically we're thematic with a major and a minor, and then I'm very opportunistic, right? I just love to
Mhm.
invest in founders that are forces of nature, and it might be a sector that I'm not as in as attuned to or as detailed on in terms of the dynamics. But if there's a founder that I can really get a lot of conviction and credibility around through multiple kind of personal as well as work references,
Mhm.
I will back them, and I will do the work,
Mhm.
which may take longer, but ultimately I believe in backing people. Not necessarily focusing or being too pigeonholed on a specific sector, because sectors come and go, and people pivot, companies change, over time. And so Slack, as an example, was a gaming company that evolved into a productivity solution over time, right? And so for us, that's probably 50% of my kind of sourcing is really founder led. And in both cases, both thematic as well as sort of being more opportunistic, we rely a bit on our data science to help me vet very quickly, what are the top 5 companies in the construction space I should chat with? Like, we can have a market map and we can feed it into our internal algorithms, and it'll start saying, hey, these are the top 10 companies. They're scoring very well. You should get in front of them. Or I might go to a demo day. I went to recently the A16Z Games demo day in San
Mhm.
Francisco, and they had a list of all the companies, and I just ran it through our internal algorithms and basically identified like 5 or 6 that I should be chatting with because they're inflecting, in a really interesting way. So
Mhm.
that just helps me be more efficient, and I think it's actually pretty differentiated versus a lot of folks in the venture ecosystem. But make no mistake about it, Grace, it's all about people first. And so
Mhm.
even if you do kind of find these companies, you have to spend a lot of time in person, spend a lot of dinners,
Mhm.
with these folks to kind of understand who they are. So in many ways, I feel like I play psychologist, in terms of our investing diligence efforts. But I'd sort of say that's kind of how I think about sourcing.
Mm. I want to know, since you mentioned you went to ACD demo day, and then like, you use algorithm to like see what makes sense. And then like, I guess without getting into too much details, but like what would be the major benchmark that you would like trying to see? So,
Yeah.
how do you filter out to like the 5 companies that actually matter for you?
Yeah, I think there's 2 things. One, I like to go to these demo days or early stage to
Mhm.
understand what themes are coming back. And so,
Mhm.
as an example, I feel like consumers coming back, based on
Mhm.
a lot of interesting companies that presented there. I think AI has always been very topical, but that has been,
Mhm.
even more pervasive throughout, a lot of these kind of early stage companies. I think vibe coding is a whole trend, and
Mhm.
a lot of
Vibe
coding.
coding? What is
Yeah,
vibe coding? I'm sorry.
vibe coding is basically, using natural language prompts to kind of code if you're a coder out there. And so,
Mhm.
like, I think YC kind of came out and said, basically, using AI tools or AI copilot tools,
Mhm.
that 95% of the code at their latest batch was basically produced through AI, or some AI copilot solution. So people are able to create companies and massive businesses very quickly,
Mhm.
and so I think there's a lot of trends around how you define developers and what type of skills you need to be to develop to be a developer. And so, these are all different trends we see. But when I kind of look at key criteria, it's like the usual kind of metric, right? It's always, great traction, great retention rates, a couple million in revenues and really inflecting. But then I think the piece that we sort of really go back on is total addressable market and how that product roadmap evolves over time to kind of build a bigger company that can generate maybe $500 million in revenues each year, right? So it's good to stay focused as an entrepreneur early on and be core, focus on your core ICP, ideal customer profile. But over time, that ideal customer profile might change. Those markets that you're going after might change as you build a bigger business. And so hearing that narrative or hearing that story from entrepreneurs helps me get conviction on how big this can really be. Because that's ultimately one of the toughest things for us as a firm. Sometimes when we're talking to these companies is everything checks the boxes. Great entrepreneur, great founder, great metrics. But can this be, a company that generates 500 million in revenues? I don't know. But is there a trail of breadcrumbs that can lead you to believing that because of the product roadmap, because of the narrative that the entrepreneur is kind of putting out there around the new markets that they'll go after once they conquer some existing markets, because of the competitive dynamics of the industry, because of the change events that they're seeing. That all needs to line up. And so that's a lot of what we look at in terms of, the entrepreneur coming in to present to us to kind of address that.
Totally. I want to keep maybe one real question and then one minute fire round. Want to be mindful for your time. Okay, so one thing is like, for example, document crunch is in the construction space, and like it's managing like construction documents or diligence, and like but in terms of like in within the construction space, I see a lot of people invest in different things like like tools and shovels related things, but like I wonder how do you like I guess like pick which subsector that you're gonna go after in like a traditional space, because in the I think especially in construction and legal, like and there's so many things that you could be doing.
Yeah.
Like what like I think sometimes it's just like kind of like you lost track on like what you're looking at, because like you could see like literally 10 different companies that are all innovating in the same space. So some are, for example, in construction, a lot of people are innovating in the drones or like the 3D mapping using AI, or like that's like a popular thing. But like, I wonder how do you define like what you should not look at or like not to spend time on, or versus like what you should be spending time on?
Yeah, there's so many point solutions in many vertical industries that are growing well, and in construction, there's a ton of point solutions, right? Everything from managing contracts and productivity around the workflows with lawyers that are managing contracts to the project engineers and project managers in the field. They have mobile apps, how the field workers get paid. So there's a fintech angle, how owners and general contractors interact with each other. There's so many different points within those workflows that there's companies building, and they're growing really early. The challenge from our perspective is you can get to 5 million in revenues, you can get to 10 million in revenues, even 20 million in revenues. You just don't know if it'll get to 100, 200, 300 million, because that might just be a point solution. And maybe Procore or Autodesk launch a feature that kills that kind of a startup over time. So the thing I try to validate, and this goes back to my earlier point, is in that product roadmap, does this address a new persona or a new market that basically expands that over time, that basically becomes something that can become much bigger, right? Because whether it's 3D mapping or productivity tools within construction, I think a lot of companies will grow to 5, 10 million in revenues. Now, whether that tool will apply, as an example, in construction, you have a lot of legal AI tools, right? Can those legal AI tools actually apply to somebody else who's not a lawyer and help them out, right? That was why we like Document Crunch. We saw that a lot of the daily and weekly and monthly active usage of the software was not just happening with lawyers and back office people. It was happening with project managers in the field and field engineers. And so for us, that basically moved from just selling into legal to selling into kind of operations, selling into project management, selling into a lot of areas that opened up that persona and hence that TAM. Now, if it's too kind of point solution-y, then that becomes hard for us to invest in. It may be a good business,
Mhm.
but it won't scale beyond 20, 30 million in revenues. So I think the key question that I frame it is, how is this a feature, or is this a real platform business over time? And that's the thing that we have to kind of get to the source of truth on, when we're looking at different solutions, point solutions, I call them, in a vertical
Mhm.
industry as well. The final thing I'll mention is, it's sometimes nice to have a data advantage, especially as you're leveraging AI, to
Mhm.
kind of offer solutions that make the lives easier for these customers. And so in the case of Document Crunch, they have a massive data advantage of all the
Mhm.
contracts they've ingested over time, to be
Mhm.
able to provide more value to project managers, project
Mhm.
engineers, as they want to stay compliant with these contracts throughout the project lifecycle for these general contractors. So I think data advantages are really important in this age of AI, and AI is
Mhm.
touching everything. So that's probably a sub note.
For sure. Okay, let's wrap with like a 30-second fire round. What's your favorite book?
My favorite book. I read a lot of books, but
Mhm.
to be open, like I haven't read too many. I'm just so busy digesting a lot of like blogs and other things. I see more podcasts, and so I'd probably say like there's a lot of books that I've read in the past, but I can't recall one more
Mhm.
recently that I thought was very interesting. Right? Like
Mhm.
probably more nonfiction that I read,
Mhm.
than kind of fiction. And
Mhm.
autobiographies are very interesting, etc. So I don't really have a favorite book, to be
Mhm.
open.
Who made the biggest impact in your career?
I think the person who's made the biggest impact in my career was, I'd sort of say, when I basically joined Titanium Ventures,
Mm.
it was really nothing. But my partner Mark Sherman has been a joy to work with. He basically gave me a lot of trust and autonomy to kind of drive a lot of value for Telstra Ventures, and so for somebody to believe in you for 11 years plus, and provide that platform for you to kind of go off and do your own thing, that's kind of rare, right? That's why you don't
Mhm.
stay at a company for more than 10 plus years. So he has been really impactful. And then I'd sort of say, like, a lot of the managing directors I worked with when I was at Jefferies, like some of them were really helpful in terms of instilling in me what I should do next, hard work
Mhm.
ethic, etc. So investment banking as a boot camp was really helpful.
Mm. Who would you invite to your dinner party?
My dinner party would probably involve Shaquille O'Neal. If you watch basketball, it would also involve Will Smith,
Mhm.
and Steph Curry. And I'm a big sports fan. And then beyond that, it would probably also have, I would say, Elon Musk be the fourth, right? And very different folks, but I think you get a combination of some pretty dramatic or provocative thought, as well as some jokes from Will Smith and Shaq.
Where can we find you outside of work?
Where, sorry, say that again.
Where can we find you outside of work?
You can find me at a Golden State Warriors basketball game. I've always been a Warriors fan for the longest time, long before they were good. So I'm always at Warriors basketball games. I love that. I'm also just always hiking with my two big dogs, and I got two young kids. So always hiking and walking around, trying to get exercise with our two big dogs. They're big dogs, so they need a lot of running.
Love that. On that note, Yash, thank you so much for coming on the show today. It was such a well-rounded conversation about how you start deals to like, building a fund to all the investing trends.
Yeah, no, thank you for having me, Grace. Always happy to do it.
Awesome. Let me quickly